Traders Library, the largest publisher and distributor of learning aids for traders, and Quicken Quotes Live, the first affordable, sophisticated charting and analysis tool from Intuit, the leader in e-finance, are proud to present Strategies for Profiting with Japanese Candlestick Charts with Steve Nison, filmed live at one of Mr. Nison's first public seminars in 10 years. This information-packed video tutorial is supported by an online manual containing the charts used in the presentation and is available at www.traderslibrary.com/candlesticks. Steve Nison was one of the first to reveal Japanese charting analysis called candle charts to the West, and is acknowledged as the Western Hemisphere's leading authority on the subject. Mr. Nison is also the author of 2 internationally acclaimed and best-selling books, Japanese Candlestick Charting Techniques and Beyond Candlesticks. Mr. Nison's work has been highlighted in the financial media around the world, including the Wall Street Journal, Barron's, Worth Magazine, and Institutional Investor. Mr. Nison is also a sought-after speaker and has presented his trading strategies internationally to market makers, analysts, institutional traders, and active online traders. In 1997, Mr. Nison founded Nison Research International, which provides customized technical advisory and on-site and web-based seminar services. Prior to that, Mr. Nison was a senior vice president at Daiwa Securities and senior technical analyst at Merrill Lynch. The charts Mr. Nison uses throughout this presentation are supplied by Aspen and Quicken Quotes Live. To find out more about Quicken Quotes Live and its charting service, visit its website at www.quicken.com/quickenquoteslive. Additional videos, books, and over 3,000 investment-focused products are available at Traders Library website at www.traderslibrary.com. Go there now and sign up for weekly email specials that will get you free books, free videos, free audios, and information on new products and upcoming events. Or call 1-800-272-2855 extension T188. And now, Strategies for Profiting with Japanese Candlestick Charts with Steve Nison.
There's a Japanese proverb that says a clever hawk hides its claws. And for over 100 years, the claws of Japanese technical analysis, that is candlestick charts, have been a hidden secret from the Western world. But not anymore. I'm pleased and proud to be here with you, and excited to be here with you today as we uncover and unlock these secrets of the Orient. Simply put, candle charts have revolutionized technical analysis. They've become one of the most discussed methods of charting around the world. And just to give you a flavor for the tremendous interest in these techniques, here are a couple of media comments. The Wall Street Journal says, Japan's candlesticks lights traders' paths. From Investors Library, whether you day trade or hold positions, candlesticks are a must. And by the way, my book sales have zoomed over the past couple of years because lots and lots of day traders and online traders are using candles. Literally, hundreds of financial publications and websites have turned their attention to candle charts. In fact, my son was, as I was using the Quicken Quotes Live, my son was looking over my shoulder, and my 10-year-old son, and he says, do they have candle charts? And I said, yes. He says, you mean if it wasn't for you, Daddy, there'd be no candle charts? And I said, yes. It's cool. I want to raise my allowance. Consider this. Probably since around 1900, so for over 100 years, the traditional charts in the West have been bar charts and bar charts and pointing figure charts. But only 10 years ago did I reveal candles to the West. Okay, before that, nobody knew about them. And candles are now becoming a basic charting technique. As I mentioned before, candlestick charts have only been around in the West since my book came out in 1990. Now, every charting system has candle charts. I think this attests to the popularity and usefulness. By the end of the session, I think you'll all agree with me that candle charts, especially for those who are new to candle charts, are going to become an integral part of your technical analysis arsenal. And I think we all agree the importance of technicals. Okay, if we think about it, technical analysis is the only way to gauge the emotional health of the market. Okay, the price is made of two components, the rational and the emotional. Okay, how many times have we seen a market move without really a change in fundamentals? Okay, the longer the time frame of our investing, I believe the more important the fundamentals are. But as we get into shorter time frames, the technicals take on added significance. And as I mentioned, the only way to factor in the emotional part, okay, let's face it, while the fundamentals gauge the rational part of our investing psychology, it doesn't take into account the psychological component of the price mover, him or herself. Jesse Livermore, the very famous and very rich trader from the early 1900s, said, "Human nature never changes, only the people change. The pockets change, the technology changes, but the market never changes." How can it? People never change, and people drive the market. Not reason, not economics, and certainly not logic. It is the human emotions that drive the market. And there's a wonderful story that takes place on the floor of the Chicago Board of Trade, speaking about logic versus emotion. This was probably about 10, 15 years ago. And the price of soybeans was rallying because there was a drought in the soybean fields. Because of a drought in the soybean area, the price of soybeans was rallying. Our attention now shifts to the floor of the Chicago Board of Trade. Suddenly, a few drops of water slid down a window. "Look," someone shouted, "rain." Then came a steady trickle, which turned into a steady downpour. It was raining in downtown Chicago. The price of soybeans began to slowly move down. Then the price of soybeans collapsed. It was raining in Chicago, all right, but nobody grows soybeans in Chicago. In the heart of the soybean belt, some 300 miles south, the sky was blue, sunny, and very, very dry. Okay, and this is the important part. But even if it wasn't raining on the soybean fields, it was in the heads of the traders, and that's all that counts. To the market, nothing matters unless the market reacts to it. The game is played with the mind and the emotions. And the only way to gauge the emotionalism of the market is through technicals, and candles are obviously a form of charting that, in my opinion, is unrivaled in giving you the insights into the psychology of the market. Another reason for the importance of the technicals, even if we're fundamentally oriented, is let's say we have two value stocks. We're value oriented. Which one do you buy? You buy one near support. Or if you want to lighten up on a position on your portfolio, where do you sell? You sell those stocks that maybe are near resistance areas. So the way I like to look at it, as the Japanese say, like the right hand helping the left, the technicals help complement the fundamentals. And more importantly, and I do lots of seminars, even for purely fundamentally based audiences, because technicals are so widely monitored. Think about CNBC, the stocks above the 200-day moving average, when you have support, resistance. So many people use charts now. So many institutions use charts that it's a major market moving influence. And really, anything that moves the market, whether we believe in it or not, really should be monitored. The technicals are important. I think we'll all agree with it. We're all here. And what's interesting is the Japanese recognized the importance of charting, of technical analysis, long ago. There was a book I had translated. It was called The Fountain of Gold, The Three-Monkey Record of Money. Crazy title, huh? And it said, when all are bearish, there is cause for prices to rise. When everyone is bullish, there is cause for the price to fall. What does that sound like? Contrary opinion. This was written in 1755. And just to put it in historical perspective, Before America was a nation, the Japanese were trading with contrary opinion. In fact, the Japanese were trading what they called empty rice contract, rice futures. And this is where charting really began. They were trading them in Osaka. And Osaka was such an important trading area that to this day I understand that the traditional greeting in Osaka is moka ramaka, which means, are you making a profit? So if any of you friends or colleagues come up to you, moka ramaka, say yes, yes, yes. Don't go, no, no, no. There's an article about my work in the Japanese Economic Journal, and it said, to know the Japanese chart methods is not enough. One must absorb the best parts of Western technicals. See, what the Japanese do is they obviously have the candles, but they know all the Western technical methods. Okay, and all the translations I've had done on the candles and all the books I've gotten on candlesticks, they all had Western technicals. So what the Japanese do is they use their candles, i.e. Eastern technicals, and they use ours, Western technicals. Okay. Now it's our turn to learn from them, to combine what I call the best of the East and the West. Okay. They've been doing this for over 100 years, and now it's our chance to learn from them. Our firm has an exclusive strategy called the trading triad. And the trading triad is the Latin word for three. And the way I like to make an analogy is this is like a three-legged stool. Okay, what happens if you take away one leg of the stool? What's going to happen to the stool? It's going to fall over, certainly. So it is with the trading triad. The first leg we'll be focusing on today, on this session, the candles, the basics, and beyond, are candle charts. Construction of the candle charts, using individual candle lines to get senses of the market's momentum, looking at some patterns. Then as we get into this afternoon, to the next session, we're going to be looking at Western technicals, the second leg. Candle charts don't replace bar charts as far as technical tools are concerned. To draw a candle chart, and for those who are new to candles, we'll spend a couple of minutes this session going over the basics. But to draw a candle chart, we need 4 data points: open, high, low, and close. What do we need to draw a bar chart? Open, high, low, and close. What that means is that any form of technical analysis you're now doing, whether it's as basic as trend lines or moving averages or as esoteric as Elliott wave or Gann or Fibonacci retracements, anything you're now doing with a bar chart, because the candles use the same data as the bar chart, you can use on a candle chart. Okay, and this is a major advantage and one of the major reasons for the explosive growth in candles. You're not giving up anything by using a candle chart instead of a bar chart. We're going to look in this next session about trend lines and candle charts and moving averages and candle charts. Okay, what I call the best of the East and the West. Then for the third leg, capital preservation. Okay, the saying is water can both sink and sustain a ship. Okay, candles, while they're unrivaled in giving us early turning signals, by the way, that's another major advantage. Okay, our firm has mainly institutional advisory clients. Okay, they like, and who doesn't like those early turning signals? What we're going to see with the candle charts is that we get potential turning signals in 1, 2, or 3 sessions. Okay, think about how long it takes to get a reversal signal on a bar chart. You have to draw a long-term trend line or head and shoulders. So while the candles are unmatched in their ability to give us reversal signals, the overall technical picture is more important than a single candle pattern. And what we're going to look at in the later session is capital preservation, analyzing the risk-reward aspect of a trade. You could have a wonderfully defined candlestick pattern, but by the time it's formed, it may be a poor risk-reward. We'll look at money management techniques. Okay, so this session we're going to focus on candle charts. What's important to keep in mind is that whatever market you're looking at, okay, that you trade personally, you can use candle charts with. Okay, so it's good for any time frame, any markets. Obviously, you have to have a market. We have open, high, low, and close. Now, you see the handouts, big handouts. The way I like to look at this is we're going to get volumes of information here. It's going to be like kind of like a fire hydrant where the water comes gushing out. Okay, the handouts are kind of like your bucket to catch through all the information. So after the seminar, it's there for you to go home and digest and chew over all the notes that I'm sure you'll be taking. This is a typical chart most of us are comfortable with. Okay, it's a bar chart, obviously. And as I mentioned before, the candle chart is constructed using the same data as the bar chart. So what I've done magically is take the same data of this bar chart and convert it into a candlestick chart. To me, it takes a bland, dull, two-dimensional bar chart, and the candle chart pushes it into like a stereoscopic, almost like a three-dimensional view. Okay, the candle charts are just visually stimulating. Your eye goes right to it. Now, notice some of these lines have white rectangles, black rectangles. Some don't have any rectangles. Okay, by the way, these are called candlestick charts. They're really called candlestick charts, but I just shorten them to candle charts. But the reason they're called candlestick charts is because some of the lines look like candles, okay, with the wicks on top. That's how the Japanese got their name. In fact, John Murphy, when he had a talk show on CNBC, John told me that a viewer called in and wanted to know what these charts look like. Hot dogs are called. And for a second, I was thinking of Americanizing them and calling them hot dog charts, but I figured then I regained my sanity. What we're going to spend a couple of minutes now going over is what the candle lines mean. I know a lot of you are already familiar with the candles, but I think the way I review it, you're going to get new perspectives out of it. But I think it's important to go over the basic construction of the candle lines to bring everybody up to a level playing field. Normally, I said, let's hold off on questions until the end of the session. This is an exception to that rule. If anybody has any questions during this segment, i.e. the construction of the candles, feel free to interrupt, because everything we'll be doing for the rest of the day is going to be underpinned by knowing how to draw a basic candle line. The candle line is constructed with two segments. There's a rectangular section called the real body, and there are lines above and below the rectangles. The real body is simply the relationship between the open and the close. If the close is higher than the open, the real body is empty or white. If the close is under the open, the real body is black or filled in. Okay, so we're comparing this session's open to the close. Okay, we're not comparing today's open to yesterday's close or close to close. It's always this session's open to this session's close. The lines above and below the real body are called the shadows. Japanese are very picturesque in their expression, so we have the real bodies and the shadows of the real bodies. The lines above the top of the upper shadow, okay, the vertical line above the real body is called the upper shadow. The top of the upper shadow is the high of the session. The bottom of the lower shadow is the low of the session. The lines to your right are called doji. And by the way, the plural of doji is or are doji. That's how I could tell somebody came to my seminar, because somebody will say, see, we have 4 dojis. I said, you didn't come to my seminar. It's a doji. Plural of doji are doji. Don't worry, you're not going to be tested on this. And notice something interesting about the doji. They don't have any horizontal, they don't have any vertical boxes. Okay, they look like crosses. Okay, a doji is a session when the open and closing are the same, okay, or nearly the same. Okay, maybe a teeny or an eighth in equities. Say you trade crude, a cent in crude. And doji are particularly significant at calling turns. And we're going to have a segment on doji in a couple of minutes. Something to consider is that candle charts can be used in all time frames. Okay, most of our clients, our advisory clients, have me look at or have our firm look at daily charts, but we also look at intraday charts. So, for example, if this was a daily candlestick line, this would be the open of the session. Now, how do we know if the open is down here or not here? It's a white real body, exactly. This would be the open of the session, the close of the session of the day. Okay, so this would be the first trade, the last trade, the highest high, and the lowest low of the session. Let's say we're looking at a 5-minute chart. This would be the open of the 5-minute period. And again, we know it's the open is here because of the black real body. The close of the 5-minute period and the highest high and the lowest low. A weekly chart. Same concept. Monday's open. Friday's close. The highest high during the 5 days of the week. And the lowest low. Any questions? Well, I was lying about not being tested. To make sure we have a firm grasp of how to draw the candles, because it's so important for everything, the rest of the session and next session, let's just spend a minute or so drawing the candle lines. And to save time, we'll just draw 3. And what I would normally suggest, especially for those who are new to drawing the candles, is look at the close compared to the open. So in session 1 with the close at 25 and the open at 23, what kind of real body would we have? White real body. Okay. So why don't we spend a minute or two just drawing the candle lines. Should have brought the music to Jeopardy. Dum, 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 dum. Okay, this is what it should look like. So. Okay, so as you so astutely pointed out, the first candle was a white real body because the close was higher than the open, as was the second. The third candle line with the close at 22 and the open at 23, obviously a black real body, very long upper shadow. We have life easy now. All you got to do is press a button and you get a candle chart. But when I was doing my research into candles in the 1980s, remember, I was the only one who knew about this. So there's not one charting system that had candles. So I had to draw all the candles by hand. Now it's great. You press a button. I'm still waiting for a system that you press a button, you get tomorrow's prices on it. But I wouldn't be here if we had that. And I certainly wouldn't tell you about it. Just kidding. Just one day. Just give us one day in advance. Now let's get any questions on this portion? Any questions? Okay. Somebody said it's self-explanatory. Sometimes the only bit of a confusion is people think it's the open compared to the prior day's close or the close to the close. As long as we remember it's always this session's open to close, we're fine. The Japanese call the real body, or they refer to the real body as the essence of the price movement. And the way the candle lines are drawn, we're going to get volumes of information about the health of the market. Let's look at this, and don't worry about flipping back to this chart, this handout again. On this session here, with a long white real body, very quickly and very visually, who is in charge of the market on that session? The bulls. Long white real body, opened on the low, near the low, closed near the high. Who's in charge here? Obviously the bears. Right? So right away, we're getting a quick visual information. Now what happens if instead of having a long white real body or a long black real body, we have what are called spinning tops? I normally just refer to them as small real bodies, but spinning tops is a Japanese name. And we're not concerned about the shadows here. We're just looking at the diminutive size of the real bodies. What a small real body is visually displaying is that there's a tug of war between the buyers and the sellers. Okay, it's not as one-sided as it would be with a long white candle or a long black candle. And what we could use spinning tops for, i.e. small real bodies, is as a measurement of momentum. So, for example, here, this is the same chart we had a couple of minutes ago where we had a bar chart and a candlestick chart. This happens to be of Lucent. Now, let's look at this time frame here at candle lines 1 and 2. If this was a bar chart, wouldn't this stock look healthy? Higher highs, right? Higher lows, higher closes. Okay, is it near a resistance area, though? Sure. Would you have resistance if this was a bar chart? Certainly. Okay, remember, whatever we do with a bar chart, you do with a candlestick chart. So, from a bar chart perspective, lines 1 and 2, if this was in English, in other words, bar charts, the stock would look fairly healthy. We would say we're getting near resistance, but it would look healthy. From a candlestick perspective, do you see what the warning sign is, a la the small real bodies? Exactly. When a market moves up, you want long white real bodies. Okay, you don't want small real bodies. Of course, you know, short-term trend, what we do it for our advisory clients, ST short-term. With these small real bodies, to me, the short-term trend would still be up, but the small real bodies would nudge it more to neutral. And one of the most valuable aspects of candles is it helps you preserve capital. If the market is ascending with small real bodies, okay, maybe you shouldn't be fully long. I wouldn't sell into this because it's still making higher closes. But this tells us, hey, the market's ascending, but there's something not 100% right here. The bulls aren't in complete control. Okay, in this market, look what was happening. Okay, as the stock was as this index, this happens to be the semis, as the index was descending, see what was happening to the black real bodies? Do we get a graphic, a visual clue that the bears are picking up steam? Anything different on this session? Small real body. Okay, it's a very tentative sign, but what this is telling us is that on this session here, there is something very different than there was during the preceding session. We probably have maybe a rising support line. Okay, although we're going to be focusing on candles in this session, keep in the back of your mind that whatever Western tools you find best, add them to the candle charts. Here you may be looking at support line, so right at a rising support line we have a small real body, a spinning top. The first sign of a potential turn, and I underscore the word potential. Just because you get a spinning top doesn't mean the market's going to go from down to up. But in this one session, we're getting a sense there's something different. Okay, the Japanese have a very pretty proverb. They say, with a fall of one leaf, we know autumn has come to the world. And what we could use these individual candle lines, like the spinning tops, small real bodies, is like the falling of that one leaf that gives us an early clue that the season or the tone of the market is changing. In fact, anything different on session X here than there was during the prior day? Small real body. Okay. And again, just because you got a small real body, it doesn't mean it's going this. You have a small real body, then you can move sideways and then up, or you can have a small real body and then move up. But what the candles shine at is telling us what's going on right now. Is there something different now than there was during the preceding session? And that's very valuable information. Okay, this is an intraday chart of the Dow. And what I tried to do is use different time frames here. We have intraday charts, daily charts. I might have one or two weekly charts also. And as the Dow was ascending, see what was happening, especially over here? Okay, the real bodies got smaller and smaller until we wound up with doji. Okay. And doji, once again, is a session where the opening and closing are the same or nearly the same. Now, a spinning top is a tug-of-war between the bulls and the bears. A spinning top relays that the market is in complete balance between supply and demand. And you don't want that during a rally. To keep a market going, you need the force of the bulls behind the market. The market has to be pushed up, but the saying is it can fall of its own weight. And when we get a doji in the market, it's synonymous with indecision. And at that point, the market becomes vulnerable. In fact, the Japanese will say that a doji, especially after a tall white candle, that the market is tired. It's at a potential transition point. On these white real bodies, who's in charge here? Bulls. Okay, very obvious. Okay. Anything different on this session? Yeah, duh. As my 10-year-old son would say, duh. Okay, a doji. Okay. And at that point, the market becomes tired. Do you sell short? And again, when it depends. I'm not sure which markets you trade. Some might trade futures, most probably equities. So when I say sell short, that's mainly true on the futures side, obviously. But say you do the 3Qs or the spiders. But sell short is synonymous with exiting long positions. On this doji here, a few questions to ask ourselves. Is the market overextended? Is it overbought? In other words, did the market move too far, too fast? Yes. Okay, and this is something important to consider. And people who are familiar only with the basics of the candles don't consider this. You could have a wonderfully defined candle pattern. I mean, this is a classic doji. But the market really has to be vulnerable to a correction. We'll look at that in a couple of minutes. You could have a doji in a neutral or lateral trading range. It doesn't mean that much. Okay. So the first thing we ask ourselves, here's a doji. Is there something different on this doji session than during the prior session? Certainly. Is the market overextended? Yes. So this doji in one session gave us a tentative clue that the market was tired. What do we do on this particular doji? Again, because of such strong momentum, I'd probably be afraid to, if you sell short, I wouldn't do that. But maybe lighten up on long positions, sell protective calls, if you're a little longer term oriented, move up stops. Okay, here's a lot of day traders are using candle charts. Here's a 5-minute NASDAQ, 100 NASDAQ, the 100 composite, the NDX. And it's exactly the same concept no matter what time frame we're looking at. Doji after a tall white candle. Forget the fact it's a 5-minute chart. It's the same concept. Is the market a little overheated? Is it a little overextended? Yes. And by the way, for those who use oscillators, and we'll talk about that in the later session, but if you're using oscillators, stochastics, RSI, and you use that to gauge overbought, oversold, still use them. Because that's when the candlestick signals, most of the candlestick signals are reversal signals. So we need a market overbought or oversold to make it vulnerable to a reversal. And we also need a trend, because if you have no trend to reverse, the candle signals don't help. And again, we'll look at that a little later. But here we have a doji after tall white candle, first sign that the market was losing its breath. Now, one of the things that I've uncovered in my, it's been 15 years of using candles, nothing from the translations or speaking to Japanese traders, a lot of things I've uncovered on my own. We know that the Japanese say the market is tired after a tall white candle. What I found is that if we use the high point, if you have a doji after a tall white candle, and you take the high point between those two sessions, the highest high, here they happen to be about the same high. In other words, the high point between session 1 and session 2, we have a doji after tall white. That level should become resistance based on a close. So for example, once I see the doji after the tall white, I would draw a horizontal line from the highest high, and that should become a resistance area. And the reason this is good, valuable information is because if, in this case, the OSX closed above this level here, that would tell us that the market is refreshed. Okay, remember, it's tired, then it becomes refreshed. It's a bullish breakout. So if you're a momentum player and you're bullish on a particular stock, either fundamentally or technically, and you want to buy it, I would suggest considering waiting for the bulls to prove their strength. Let the market close above the resistance level to prove that the bulls have taken control. Okay, even the prior two charts, and again, don't worry about flipping back on this. Here we have a doji after a tall white candle. I would take this high. That would be my resistance area. You see that? And you could see where the market stalled the next day at the black real body. Okay, even the first one. And again, sorry for this mess here. But look, remember the Dow? This was handout 12. And again, don't worry about flipping back because we can see it on the screen here. Doji after a tall white candle. Where would my resistance be? Right here. Okay. You can see how it punctured it intraday, but as long as it doesn't close above resistance, okay, it's still valid resistance. And what's nice about this is that we could say, hey, there's always a price that... What's great about the technicals is there's always a price that says we're wrong. Okay, it's hard to do that with the fundamentals. So on a close above this area, it would be a bullish breakout. Again, same concept. Doji after tall white candle, take the highest high between the doji and the tall white candle, and that becomes a potential resistance area. On a close. Yes. If you have a doji after a tall white candle, whatever is the highest high of those two sessions, so we have session 1 and session 2. Session 2 has the highest high. Okay, we're looking at the top of the upper shadow. So that becomes our resistance area. If, in this case, let's say session 1 had a very long upper shadow. Like, this is chart 15. Sorry. Okay, if session 2 I'm sorry, session 1, I made this the green line, the upper shadow. If that had an upper shadow that long, that would become the resistance area. Okay, anybody want me to go over that again? Okay, good. And just to make it, just because I think this is such an interesting aspect. Here we have a doji confirming a resistance area. Again, if this was a bar chart, where you certainly would have resistance, this is chart 16, we would certainly have resistance right around 36.5. And we can see how the doji, and by the way, you see this small real body here? That although it's not exactly a doji, to me that real body is so small it has the same implications as the doji. Yes? What?
Close is supposed to be the important price. So why would the shadow be the determining factor of the resistance?
Because it's the highest. It's something I found from my own research. The highest high. Okay. Okay, this is something I alluded to before, and this is an important chart because here we have a couple of doji at 1 and a doji at 2. The question we should ask ourselves is when is the doji more important? Okay, which doji, 1 or 2? Now, look at doji 1. To me, what I'll look at is the immediately preceding range. Okay, and that looks, the doji kind of emerged after a couple of days of lateral trading. So is the market really overextended then at the doji? No. We're kind of in the middle of what the Japanese call a box range. If we have a lateral trading range, i.e. a box range, and we have a doji in the middle of the range, is there a trend to reverse? No. There's no exactly. And again, this is going to put you ahead of those who understand only the basics of the candles because doji are so easy to see on the charts. And sometimes a little knowledge is a dangerous thing. I gave a seminar a couple of years ago to a bond house, and one of the traders wrote back to me and said, you're certainly right about a little knowledge being dangerous. We're all running around here saying doji, doji, doji. A doji like this has no trading implications because it's echoing on a micro scale. The market is at a point of indecision, but on a little larger macro scale, that's what the box range is, the lateral trading range is showing us, right? Now let's look at the doji at 2. Anything different? Okay, 1, is the market, do we have a trend to reverse? Yes. Is the market a little overheated? Yes. And even, normally I'd look at oscillators and so forth for our clients, but even looking at this, that doji takes on more significance. And actually, the doji at 2, what becomes our resistance area? Let me zoom in here. Okay, give me a price level. What? Right, 290. Okay, 2.9. Because we take the highest high. Okay? So although the next couple of days traded laterally, as long as we don't puncture that resistance, it's still valid. A close above, and that's important, a close above it. This is where it becomes a little tricky, Because if you wait for a close above a certain level, again, if you're selling, if you're going to, say you're short, and you wait for a close above a certain level to get out of the shorts, by the time you close above it, it could be way above there. But I see time after time where you push through resistance, and I'm sure you see it also. You get through resistance intraday, but you don't close above resistance or below support, and it's still valid. Okay, something we're going to touch on more deeply in the afternoon is looking at the candles and the overall technical picture. I don't know how many of you are here only for the mornings for this session, but just be a little careful about trading based only on the techniques we talk about here. You're going to certainly get a lot of valuable information, but I want to mention now, for those who don't have, won't be at the other session, is that the overall technical picture is more important than the single candle line. Case in point. Here we have a doji, but it's a new high close. And as somebody pointed out, closes are important. Okay, a lot of technical systems are based on closes only, right? Moving averages. Some people use what are called, I think, line charts, where they just draw closes. So this is a new high doji, but before turning even a little negative on this particular market, to me, I'd want some bearish confirmation. What that bearish confirmation would be a close under the doji's real body. So in other words, a close under 45 and a quarter. So although the doji would get us a little cautious about the market, to me the trend would still be mainly up because it's a new high close. Okay, to me what would be a little more negative, I don't see one here, but if we had this. And I think we can understand why. Okay, there's a doji after the tall white candle, it's not a new high close. Okay, so the general concept is look at the overall technical picture before acting on a single candle line. Okay, this particular doji, I enjoy talking about it mainly because of the name. This is called a gravestone doji. And it looks, I'll just draw it here. Okay, the gravestone doji looks like that. Which three prices are on the low of the session? The open, the low, and the close. And what the long upper shadow is showing us is that sometime during the session, the market had rallied there, but what happened by the end of the day? Closed on the low. Exactly. And by the way, the reason this is called a gravestone doji is because the Japanese say it represents the gravestone or the tombstone of the bulls who died defending their territory. And just because you have a gravestone doji doesn't predict a move like this. An aspect to keep in mind is that candles do not give us price targets. That is why it's so important to continue using Western technicals. Candles will give us the turning signals, okay, the early turning signals, but they don't predict the extent of a move. And this is also a critical factor, because if we get a candlestick pattern and a reversal signal and it comes, late, say we're way off the highs here. Okay, say you get your signal here. Let's say you're selling it or you want to exit longs. If you get this signal there, okay, the risk is, remember the highs. If you have a doji after a white candle, you take the highest high. We have to be looking for at least that, more than that amount, to make it a good risk reward. And we're going to focus a lot on that during the latter session. Okay, but the main thing to keep in mind is candles don't give price targets. You'll have to get your own price target, and I'll show you some of my favorite Western technical measurements later. But you're going to have to get your own price targets, depending on what you use, and then decide if the candlestick signal is a good risk-reward at the time the signal is formed. Okay, the next technique we're going to look at is something unique with candles. And use the middle of that white real body as a potential support area. I'll give you my funny pointer. This is good for hitching. I got this in Europe. So you could take the middle of the long white real body, and that becomes first potential support. The next support, actually the more important support, is the bottom of the white real body. And if you have a little bit of a lower shadow, I'd probably even go down to that. I'm sorry, what's that? The major support is the bottom. The important support is the way the Japanese use this is the bottom of the lower shadow. But I've kind of massaged it a little bit, and if I see a little lower shadow, I'd probably use that. Now, the middle of the white real body, probably on a scale from 1 to 10, I'd weight it like a 4 or a 5 as a potential support area. It works better if you have high volume. But the reason I think it's important to be at least aware of this concept is because sometimes you have no other way of getting support. Let's imagine this was like a 5-minute chart, or a daily chart, doesn't matter. And you have this long white real body. Let's say the market closed here at 30 and opened here at 23. So as your first support, down here at yesterday's low. So what we could do is use the middle of the white real body as a potential support area. What I usually do for our clients, and if you have access, I would certainly suggest, and certainly Quick and Quotes Live has this, is sometimes if you have a long white real body on the daily chart, look at an intraday chart. Okay. Sorry, a little lunch. So you could look at an intraday chart, and maybe you'll find a support, a congestion area there. But if you have no other way, if you only have a long white real body, and you could use the middle of that white real body as a potential support area. So let's look at that. So here we have a middle of the long white real body. Here. And over here, and over here. And again, you could see, here we broke under the middle of the long white real body. So this would be, we're on chart 21. So this would be S1. What I do for our clients, we have S1, S2, support area 1, support area 2. S1 would be here. Guess where S2 would be? All right, the bottom of the white real body. Okay. The bottom of the white real body is actually, I placed a little bit more emphasis on it. Let's look at this. How are we getting a sense? Over here, and maybe over here, and over here. Again, we're on the same handout. Okay, we're on chart 21. Are we getting a sense that the bears maybe are having some problems? Are they're losing control near 31? Okay, see the small real bodies? Right around the same area. We'll look at later, the more technical signals we have joining at the same area, the more important that area becomes. Okay, whether it's a group of candlestick signals like this, the small real bodies, we'll look at lower shadows in a couple of minutes. Whether it's a confluence of candles or candles combined with Western technicals. The more clues we have, the better of the potential of the trade. Okay, the Japanese say the water of a great ocean comes one drop at a time. And what we can look at is these little drops of water, these little clues giving us a sense, making this ocean of information. We're taking these little drops here, and they're adding up to an important picture. Okay, during this ascent, the middle of the white real bodies became support. Here we have a doji. Okay, after a tall white candle. Once we closed above it, over here, it's a bullish breakout. Okay, so the market, after we got this the doji here, okay, the market retreated, it came down. Okay, so we had a correction. The doji worked fine. But once you closed above it at time frame X, it's a bullish breakout. So if we're looking to buy on strength, we would have done it on day X. But the main thing here is that we take the middle of the white real bodies as support. The same concept with black real bodies. We could have the middle of a long black real body as a potential resistance area, and the second resistance area is the top of the long black real body. Same idea as the long white real body. As far as selling into strength on the middle of a long black real body, I'd probably be a little reluctant to do it, okay, unless you're seeing the market stalling there, unless something else is confirming it, because, again, I probably weighted a 4 or 5 as far as probabilities of the market turning from there. But if you have no other way of gauging a resistance area, you could use the middle of the long black real body. More important level, the top of the long black real body. Okay, so here we have some long black real bodies. And we're taking the middle of them as potential resistance areas. R1, and so this would be R1. Interesting, here's R1, and R2 over here. It's the middle of black, and obviously R3 would be over here. And again, let's look at these clues here. Anything going on? This happens to be applied. Zoom this over here. Anything going on right around 39.5, a la bodies? Doji after tall white candle. Then we're going to look at adapting to the market, because here we had a doji after tall white candle. This should have been a resistance area. We closed above it over here, so it looked like a bullish breakout. But what happened is the market failed to sustain the momentum. Again, we'll discuss this in the next session. But small real body. The next time we got to 39, another small real body, another small real body. So although if this was a bar chart, the stock would not look that unhealthy because it's holding near the highs very well. But from a candlestick perspective, what are the real bodies showing us? Be careful. Because one of two things is happening with those small real bodies. Either the bulls are pulling back, or if there's a lot of buying, bullish buying, what's the only thing to keep this in check? A lot of supply. Okay, and we're going to look at volume, because if you have a high volume spinning top at a new price high, it's normally bearish. Because the high volume is telling us, again, that's something we'll look at in this next session, when we talk about candles and Western technicals, because the high volume is telling us, with a small real body, that there's a lot of buying demand. We know that from the high volume, but there's an equal amount of supply absorbing all the demand. Not a real healthy scenario. So I think while we agree we can get volumes of information from the real body, We've only talked about the real body so far. Look how much insight we've gotten into the markets by looking at just the opening closing range. The shadows are also very, very important. And shadows should always be considered when analyzing the candle lines. We're focusing now on using single candle lines. Okay, a little later we'll get into patterns. Here on your left, we have a long white real body. But anything offsetting some of the bullishness of the white real body? The long upper shadow. What that is showing us is that, as the Japanese would say, it's a little bit of a tongue twister, the long upper shadow suppresses the rallying strength. Okay, so if it wasn't a long, if it wouldn't have that long upper shadow, it would look fine. This offsets some of the bullishness. Now, normally one session's long upper shadow, or as we'll look at in a couple of minutes, the lower shadow, one session's long upper or lower shadow doesn't make that much of a difference. Okay, I wouldn't go from bullish to bearish because of an upper shadow. Where I would stand up and take note, what would give me a visual warning signal, a visual alarm, is if we're getting session after session after session of upper shadows. Okay, one of the things we could use candles for is pinpointing pivotal support and resistance areas. So here we have 3 sessions, whether they're intraday or daily or weekly, it doesn't matter. 3 sessions with a series of long upper shadows showing that the market is rejecting these higher levels. Because what's happening in each of these sessions, at some time during the session, the market had rallied. What happened by the end of the day? Were the bulls able to hold the market into the close, highs into the close? No. And by the way, I didn't do this on purpose. What were the real bodies showing us here also? Getting smaller and smaller. Again, would I be bearish? Probably not. Would I be cautious? Certainly. Here we have some black real bodies, but the long lower shadows, and in this case, coincidentally, the lower shadows had the same lows of the day, of the session, but the long lower shadows show us that the market's rejecting lower levels, so it offsets some of the bearishness of those black real bodies. Okay, let's look at this segment here on the next handout. Now, during these times at 1 and 2, let's mentally translate this into a bar chart. We did this before. Would this look bearish with a bar chart? What's happening with areas 1 and 2? Mainly higher highs, higher closes, higher lows. Everything looks great. Now let's make it into a candle. See something different? Small real bodies. How about during price ascent 2? Anything with the shadows? Those long upper shadows. Long upper shadows. Again, it doesn't predict, a move like this. Candles don't do that. It just shows us that the market, although it may look, the Japanese have a nice saying, like leaky boats brightly painted. The market might look good. Hey, we're making higher closes and higher highs. But these upper shadows are a warning signal. It makes the market vulnerable. Again, would I go short? No. I don't want for you to get more out of candles than they're meant to give you. Would I be careful about adding to long positions? Again, yes. Okay, here we have a chart. Long upper shadows. See, after we get a couple of long upper shadows, 2 or 3, is when we would stand up and take notice. And this is one of the wonderful things about the candle charts, is that they're so visual. Okay, this is the same data as a bar chart. Same data. But think of all the mental gymnastics we'd have to go through if we had a bar chart. We'd say, well, this day, we closed off the highs. The bar chart looks like this. And you have to go through, as I said, mental gymnastics to figure out, well, the bulls couldn't hold the highs. The Japanese used bar charts 130 years ago, and they gave them up in 1870 for candle charts. And that's what's happening here in the West. Can anybody think of a reason to use a bar chart? There's absolutely no reason to use a bar chart, because you're going to get all your bar chart signals in candle charts, but there's no such thing as long upper shadows and small real bodies on a bar chart. So here we have a series of long upper shadows showing us that the market is hesitating. It's a visual resistance area. And this next chart, and this is so typically Japanese, the wonderful expressions. Here's a market rising in agony. This is what the Japanese literature was like. I had 13 books translated from Japanese to English, and they were all like this, just wonderful terms. It was very difficult, though, because a lot of the Japanese, the candles are, how would I say it, the Japanese didn't do things explicitly, kind of had to extrapolate what they were talking about. But they had wonderful expressions like this, and it kept my incentive to do all the years of research going. But market rising in agony. And we can understand why the expression is that. Why is the market right? We can see the market's moving up, but is it doing so aggressively? Is it doing so comfortably? No. It's rising in agony. What better way to say it than that? Long upper shadows, small real bodies. Okay, we'll look at later the real coup de grace in the next session when we gap down. Okay, for those who are familiar with candles already, it's a window, and windows are absolutely wonderful, and we'll focus on that in a later session. Very important signal, windows. So that was the way this would be for our advisory clients. During this frame here, short-term trend, up, neutral. Okay, still up because we're making mainly higher highs. As soon as we gap down, the short-term trend becomes neutral, down. Okay, because of that gap down. And again, we'll focus on gaps later. Okay, on the Dow, okay, this is a daily chart. Session after session after session, long upper shadow. Okay, you have to be hit over the head to show there's some problems there. Doesn't forecast a precipitous decline like this. All we should read from this is that the market is vulnerable. Nothing more. It's just vulnerable. But that could be important information about your, how you're going to adjust your trading strategy. Think it looks like, does it look like is building a base here? Sure does. Four out of 5 sessions, what was happening is that the bears hit the market, pummeled the market down to these lows. Okay, a little doji there. Down to those lows. What happened by the end of the session? Do those lows hold into the close? No. Okay. Okay, so if we accumulate there, what price would we say we're wrong? Probably maybe a close into 55. Now, by the way, this doji here, okay, the green arrow, based on what we mentioned before, the doji in that case was not that important. And I think we could see why. Did we have a real trend to reverse? No. So box range. The reason this particular doji was important, not so much as it was a doji, but it was because of that lower shadow. Everybody see that? So in other words, there's nothing really potentially positive about the doji because the market isn't oversold. But because that doji happened to have a long lower shadow, that was the positive aspect of it. Okay, here we have a series. Here we have a series of long lower shadows. And these particular candle lines with the long lower shadows and small real bodies at the top end of the trading range are referred to as a hammer. Okay, the hammer will be the first of our, what I call one-sided shadows. We're going to look at candle lines with long lower and upper shadows and candle lines with both long upper and lower shadows. The hammer, the Japanese call it a hammer because supposedly the market is hammering out a base. And a hammer is defined as a candle line with a long lower shadow, ideally 2 or 3 times the height of the real body, little or no upper shadow, and a real body at the top end of the trading range. And the color of the real body is not important. It could be black or white. Because even if this was a black real body, wouldn't the close still be near the high? Right? So it has to be a small real body, right? Right near the high of the session, and a little or no upper shadow. The reason you don't want much of an upper shadow because you want to show the market close right near the high of the session. The hammer is a bottom turning signal, a reversal signal. What kind of trend do we need to reverse then? Downtrend. Very critical aspect. So that's why I'm showing here the market's descending, and we have a hammer giving a potential turning signal. Okay, nice hammer. Long lower shadow. Small real body at the top end of the trading range. An important, another aspect to consider, again, it's something I touched on briefly a little while ago, but I want to focus more on now, is the risk-reward aspect of a trade. A beautifully defined hammer would be something like this. Real long lower shadow. Okay, that looks great. Problem is, when do we get the signal? What do we need for the candle line to finish the candle line? The open, high, low end, close. So what that means is we have to wait for the close. Look how far off the lows we are by the time you get the signal. So one of the things I suggest to consider is use the bottom end of the hammer as a potential, as an area to consider buying if the market retreats to it. In other words, in this stock, look at where we got the signal. The low is 43. When did we get the hammer? At 48. So if we buy in the hammer, you're buying $5 off the lows. Nothing wrong with that if you're looking for a $20 rally. But if you're looking for a little pop, it would not be an attractive risk reward. So what we could do is, if the market retreats back to the lower portion of the hammer, to consider accumulating there. Because if it closes under the hammer support, we should be out of long positions. Of course, there are going to be many times where we don't have that luxury of the market retreating. After the hammer, the market keeps on going. But there's lots of other markets we could, trade and lose money in, right? But I don't believe in running after a market. Okay, in AOL. Okay, long lower shadows. The hammer's here. Okay, this is a 30-minute chart. By the way, I knew it was time to change brokers because I wanted to buy AOL, and my broker said, "How do you spell that?" But we have the long lower shadows here. And again, just to refine this a little bit, the first two candle lines here would be hammers to me because we're coming after a downtrend. This line at 3, although it has the same shape as a hammer, I wouldn't really define it as a hammer because, see, it's a trading range. But the reason this became important is, of course, that long lower shadow is confirming a support area. So a hammer really must come after a downtrend. You need two things for a candle line. You need the trend and the shape of the line. So here we have the shape of the line, but we really didn't have a downtrend to reverse. But what's nice about candle line 3, the hammer-like line, I guess you can call it, is it almost exactly confirmed the first hammer, the hammer support. Okay. Okay, here, where's our buying area in this? Okay? Did we get a chance to buy it? All right? It's not always going to be this nice. You know, it's not always going to get to the bottom of the hammer. Here, the hammer was actually line 1. That was the hammer. That's our support area. You may even bought it on the second day, on the second 30-minute period, because it was near the hammer support area. Okay, here we have another hammer. So we ask ourselves, is the shape of the line right? Is the lower shadow about 2 or 3 times the height of the real body? I'd say so. Is it following a downtrend? Yes. When I talk about downtrend, I look at the immediately preceding move. You know, here. Any indications of problems up here? Spinning tops. Did the hammer become support? Yes. In this case, it was actually confirmed by a doji. Is the market rising in agony? Green area? Sure. Are we near the top end of a trading range? Sure. We have a hammer where it says hammer. Okay. But I want to show you something interesting about this chart also. Okay, nothing to do with particular patterns, but how to use it. We're still focusing on individual candle lines, single candle lines. A couple of sessions before the hammer, okay, at time frame 1, what kind of real body do we have? A long black real body. What would we expect after a long black real body normally? You know, we have the bearish momentum with us. It's kind of like a broad jump. You know, you're running and you're jumping off. We're at the lows of the day on that long black real body. What would we expect? Margin call. I like that. I'll give you the microphone. That's good. But we were expecting, beside a margin call, we expected to go down the next day. And what happened the next session? Did it continue down? No. Now, that in and of itself doesn't mean that much. But notice what's happening right around the same price level. And then, of course, we get the hammer, which should be support. Another long black real body. what would you expect to happen? Okay, it should go down. What's happening? Did it? No. Okay. Another black real body, what would we expect? Okay, to go down? Would you want to be short the stock first of all? No way. Not anymore. Okay. Would you be comfortable buying it? Maybe. Because what's happening is that each session after the black real body, during the black real body, who has control? The bears. What happens the next day? Do they lose control? Yes. The bulls, may not have gained full control, but this is showing us that right at the same price, right at around 208, okay, the bears just could not maintain control. Okay, if this happened again once, or maybe even twice, I wouldn't take notice, but 3 times, something important. Something important is going on there. Okay. The next thing we'll look at. Well, and then we'll take a break. We have a hammer. To your left. Now the same shape line. Okay, notice small real body, black or white, long lower shadow, where the real body is the top end of the trading range. The same shape as the hammer. This is called a hanging man. It comes after a rally. Okay, that's the only difference between a hammer and a hanging man. The hammer comes after a decline. The hammer comes after a rally. The reason the hammer comes after a decline, a hanging man comes after a rally. And the reason it's called a hanging man is because it's supposed to look like a man hanging with dangling legs. That's where the Japanese got the expression. And the hanging man is a potential top reversal signal. The reason I wanted to focus on the hanging man is to send out a note of caution about it. Don't place that much emphasis on the hanging man. And I'll explain why in a minute. But let me show you, just to make sure we have an understanding, the difference between the hammer and the hanging man. In Microsoft, okay, one comes after an ascent, a rally. So that's a hanging man. The market comes after a rally. 2 is a hammer. See, it's the same shape line. 2 is a hammer because it comes after the decline. So the only difference between the hammer and the hanging man is the preceding trend. A hammer after a decline, a hanging man after a rally. The reason that I wanted to focus a little bit on the hanging man is, let's look at the shape of the hanging man line. Is there anything bearish about that line? Long lower shadow. What does the long lower shadow normally represent? It's positive, right? The market touched these lows and bounced off it. Maybe we could say with a hanging man, it's a small real body. Or at a high price level, the market becomes volatile. It shows that it broke, but it was able to bounce back. The thing with the hanging man is, in and of itself, it's not particularly bearish. But what happens the next session can confirm a hanging man. Let's look at this one, again, with Microsoft. Anybody who bought here on the opening and closing of that hanging man at 1 bought at the highs of the move. And a lot of trading goes on at the opening and closing. Nothing wrong with buying at the highs, okay, as long as they don't stay the highs. What happens in next session if we close under the hanging man's real body? Anybody who bought on the opening and closing of the hanging man is in pain. They're losing money. Okay. And a lot of us have been in that position. They may decide to bail out. Okay, they may get out. And that may cascade into more selling pressure. So the rule is, if you have a hanging man, just take notice of it, but I would only wouldn't even be a little negative until we close under the hanging man's real body. Because the line itself is a positive line with a long lower shadow. If we closed, in this case it was at 88, it closed above 88 the next session after the hanging man, are the longs in pain or are they happy? They're happy. So you forget about the hanging man. Same thing here. Hanging man, high of the move. And ideally, the hanging man should be at the high of the move because you want the longs there, the people who bought in the opening and closing, at the highs. And the next session closed under the hanging man's real body. And this had a bit of an upper shadow, but that's okay. Okay, some hanging men. Okay, right? Were any of them confirmed? No. And this is the thing to keep in mind. Okay, because the line itself is actually positive until we get a close at a minimum under that real body. I wouldn't even consider selling. Okay, the Japanese have a saying, step after step, the ladder is ascended. Well, we'll continue ascending the ladder after our 15-minute break.